I wouldn't put any dastardly deed past the U.S. government, but I think the probability of it is low. People have asked me my whole life about the possibility of government confiscations of IRAs, too. The government can steal from you in ways that make them popular. Quantitative easing, which is to say printing more currency unbacked by anything, devalues the currency that you already have in your bank account. That's theft. When governments do it, they're popular. When government increases taxes on some, that's often very popular with the people that they didn't increase taxes on. It's a form of theft that gets them elected. When governments run big deficits like they are today, which is in effect stealing from the unborn or young people, that's popular with the people who are current beneficiaries of that. If you look at Social Security, Dunnigan, our generation, voted itself all kinds of cool benefits, Medicare, Medicaid, Social Security. Yes, we paid into them, but not to the extent that we're going to draw out of them. So the $100 trillion in unfunded, net present value of unfunded liabilities, the benefits that we will generate being paid for by younger people is theft. And 80% of the American population think that theft is more than justified. Given the fact that the government has all these ways to steal from us that are extremely popular, why would they engage in overt theft, which would be unpopular? I was reminded by a congressman, and I won't name him, that Congress is aware of the fact that there are 400 million guns in circulation in the United States. Think of yourself as a congressman. You run the risk, you run the ire of all the gold bugs, many of whom are armed, which is a risk, or you steal from the unborn, which makes you popular, gets you reelected time after time after time. Would you prefer to be loved for being a thief?
What does Rick recommend on either how many troy ounces or percent of a portfolio one should have in gold and silver?
That really depends on the individual and the type of portfolio one has. As an example, a 65 to 70-year-old retired person with a lot of time left on Earth, whose portfolio is 75 or 80% in long-term bonds, needs to own a bunch of gold. Inflation murders a portfolio like that. They will get the bond yields, but the bond yields will buy less and less and less and less and less. An investor who has a reasonably leveraged real estate portfolio, reasonably, not unreasonably, who's a decent real estate operator, who benefits from inflation because the ability of competitors in real estate to construct new product in inflationary times to compete with his existing product is low. So that person would need to own less gold. So while I know that everybody wants a one-size-fits-all answer, there isn't one. It depends on the needs of the individual, and it depends on the composition of their existing portfolio. I own gold as an insurance asset. It helps me sleep nights and stay calm. And at 71 years old, 1 year of age, sleep is a very nice thing. I don't own gold because I think it might go from $2,400 to $2,700. I own gold because I'm afraid it'll go to $9,000 or $10,000. Somebody who has less fear than me probably wants to own a little less.
Rick Rule's skepticism about the probability of government confiscation of IRAs highlights a critical point. Governments have subtler, more popular ways to extract value from citizens. One such method is quantitative easing, which involves printing more currency unbacked by anything substantial. This devalues the currency you already have, effectively stealing from your savings. Yet this kind of financial maneuvering is often well received by the public, who may not immediately feel its detrimental effects. When governments increase taxes selectively, they gain favor with those not directly affected. This form of wealth redistribution is another popular way for governments to enact financial policies that, in reality, equate to theft. Running large deficits, as the current administration does, is essentially borrowing from the future, stealing from the unborn and young people. These policies are popular with current beneficiaries but set the stage for long-term financial instability. Take Social Security, for example. Our generation voted for numerous benefits under this program, along with Medicare and Medicaid. While we paid into these systems, the returns we expect to draw out far exceed our contributions. This results in a staggering $100 trillion in unfunded liabilities. The younger generation will bear the burden of funding these benefits, a clear case of intergenerational theft that the majority of Americans seem to accept as justified. Rick Rule also touches on the political reality of the United States, where there are approximately 400 million guns in circulation. This statistic underscores why the government might shy away from overtly unpopular moves like seizing gold or IRAs. Instead, they prefer methods that maintain their popularity, even if these methods are less direct forms of theft. When discussing investment strategies, Rick emphasizes the importance of tailoring your portfolio to individual needs. For example, a retired person heavily invested in long-term bonds would benefit from holding a significant amount of gold. Inflation erodes the value of fixed-income investments, making gold a critical asset to preserve wealth. Conversely, an investor with a leveraged real estate portfolio might need less gold. Real estate can benefit from inflation, as the cost to build new properties increases, reducing competition for existing assets. This scenario highlights that there is no one-size-fits-all answer when it comes to gold and silver investments. Instead, the composition of an individual's portfolio and their specific circumstances should guide their decisions. Rick Rule's personal approach to gold is one of caution and long-term thinking. At 71, he values gold as an insurance asset, providing peace of mind and financial stability. His investment in gold is not based on short-term price movements, but on the potential for significant appreciation if economic conditions deteriorate. This perspective aligns with historical trends. For instance, during the 1970s, silver prices skyrocketed from about $1 to $50 per ounce. While this was an extraordinary case, more recent bull markets, such as the early 2000s, saw silver increase from $5 to $50. Such movements illustrate the potential for substantial gains in precious metals during periods of economic uncertainty. Rick also mentions that when gold establishes momentum in a bull market, it often attracts generalist investors. These investors, encouraged by gold's performance, then turn to silver due to its lower unit cost and higher volatility. Historically, this shift has occurred midway through bull markets, leading to dramatic increases in silver prices. However, predicting exact timings for these shifts is challenging. Rick wisely refrains from giving specific dates but suggests that we are in the early stages of a precious metals bull market. Patience is crucial for investors looking to capitalize on the eventual fireworks that silver can provide. For those unfamiliar with silver bull markets, the dynamics can be surprising. The 1970s saw silver prices multiply 50-fold, though such extreme moves are rare. More typical are tenfold increases, as seen in the early 2000s. Despite low expectations among some modern investors, these historical precedents indicate the significant potential of silver. The discussion about the utility of silver is also essential. Unlike gold, which is primarily valued for its investment and monetary uses, silver has substantial industrial applications. It is used as a germicide in solar energy applications and in various other industries. This dual utility adds another layer of demand for silver, contributing to its investment appeal.
I've had hours of discussions with you, Dunnigan, about the reason why I think the gold price inevitably goes higher. And my experience has been that when gold establishes the momentum in precious metals, and then the generalist investor comes in, that the generalist investor is encouraged by the momentum in gold and buys the asset with lower unit costs and more volatility, which is to say silver. This usually occurs about midway through a bull market. No reason why history has to repeat itself there. But when silver assumes leadership from gold, it moves further and it moves faster. I know that the gentleman would like me to give him a date. I'm too old and smart for that. I would just suggest to him that we're in the early innings of a precious metals bull market, and he needs to be patient for gold to establish a dominant trend before silver really gives fireworks to the upside. It's worth waiting for, by the way, Dunnigan. Your younger audience won't be familiar with the dynamics of a silver bull market. The first one, of course, that I lived through was the 1970s, where silver went from about $1 to $50. That's not representative, I think. A better market to pay attention to was the early 2000s market, from about $5 to about $50, a tenfold move in silver. Too many silver bugs these days have low expectations. High expectations in terms of time, but low expectation in terms of dimension. I read all kinds of, I could care less about a $5 move in silver. I've experienced a couple tenfold moves and one 50-fold move. So a $5 move is of no particular interest to me. I don't think that the ratio, which is to say 16 to 1, matters because it doesn't take into account utility. Prices move really as a function of utility. Silver has two utilities. One, which is highly speculative as a medium of exchange and a store of value, which is to say its investment characteristics. The other is its industrial utility, its use as a germicide and its use as a reflectant in solar applications. I think the attention that silver adherents pay to the 16 to 1 relationship between the relative abundance of gold and silver in the Earth's crust is probably less important than the social roles that they've both played in terms of investment demand or the industrial roles that they both enjoy. Sure, the discussion about reversion to mean on your show, Dunnigan, referred to the fact that the market share of all precious metals related investments, including physical precious metals, equities, and public precious metals debt, comprises less than 0.5% of the value of all savings and investment assets in the United States. That's important, first of all, because the number is so small, but secondly, too, because the 4-decade mean market share of precious metals and precious metals-related assets was 2%. So if you had reversion to mean, which I believe you will, that means that the demand for this asset class grows fourfold in the largest savings and investment market in the world. I think that's a broad enough asset class and a broad enough competitive universe that reversion to mean is an important statistical tool. To the extent that you want to use reversion to mean in something more volatile or more constrained, seems to me problematic.
As we transition to the broader implications of these insights, it's clear that understanding the strategic value of gold and silver is crucial in today's economic climate. The dynamics Rick Rule outlines point to a growing recognition of the need for financial security in a world where traditional metrics and government policies are increasingly unreliable. One of the most critical aspects of investing in precious metals is their role as a hedge against economic instability. Unlike fiat currencies, which can be devalued through policies like quantitative easing, gold and silver retain their value over time. This intrinsic value makes them a reliable store of wealth, especially during periods of high inflation and economic uncertainty. The geopolitical landscape also plays a significant role in shaping the demand for gold and silver. For instance, ongoing tensions between major economies and the potential for sanctions increase the attractiveness of these metals as safe haven assets. Countries like China and Russia have been steadily increasing their gold reserves, signaling a strategic move away from dependence on the US dollar. In addition to geopolitical factors, the macroeconomic environment is driving demand for precious metals. The extensive use of fiscal stimulus and low interest rates in recent years has created a precarious financial situation. As these policies unwind, the potential for economic disruptions increases, making gold and silver even more appealing. For individual investors, the key takeaway is the importance of diversification and risk management. Gold and silver should be viewed as essential components of a well-balanced portfolio. They offer protection against inflation, currency devaluation, and other economic risks that traditional financial assets may not adequately address. Moreover, the accessibility of gold and silver investments has improved significantly. Investors can choose from a variety of options, including physical bullion, ETFs, and mining stocks. Each of these options offers different levels of exposure to the metals and comes with its own set of benefits and risks. Physical bullion, for example, provides direct ownership of the metal, offering the highest level of security. However, it also requires secure storage and may involve higher transaction costs. ETFs and mining stocks, on the other hand, offer more liquidity and ease of trading, making them suitable for investors looking for flexibility. The historical performance of gold and silver during economic downturns further underscores their value as safe haven assets. During the 2008 financial crisis, for instance, gold prices surged as investors sought refuge from the collapsing stock markets. Similarly, during the COVID-19 pandemic, both gold and silver saw significant price increases, reflecting their role as hedges against uncertainty. Rick Rule's insights into the potential future movements of precious metals are also worth considering. He suggests that we are in the early innings of a bull market for gold and silver. This perspective is supported by the current macroeconomic conditions, including high inflation, rising interest rates, and geopolitical tensions. Investors looking to capitalize on this trend should be prepared for potential volatility. Precious metals markets can experience significant price swings, especially during periods of economic instability. However, this volatility also presents opportunities for substantial gains, particularly for those who are patient and strategic in their investment approach. Another critical factor to consider is the supply and demand dynamics of gold and silver. Both metals have limited supply, which is constrained by mining production and existing reserves. At the same time, demand is driven not only by investment needs, but also by industrial uses, particularly for silver. For example, the growing emphasis on renewable energy and technology has increased the demand for silver in solar panels and electronics. This industrial demand adds another layer of support for silver prices, complementing its role as an investment asset. In conclusion, the current economic environment presents a compelling case for investing in gold and silver. These metals offer a unique combination of security, diversification, and potential for significant appreciation. As the world navigates through uncertain times, having exposure to gold and silver can provide a crucial safeguard for your wealth. For American citizens and allies, the shift towards precious metals has profound implications. As the global economy moves away from reliance on the US dollar, the value of gold and silver is likely to continue rising. This creates a unique opportunity for investors to protect their wealth and capitalize on the changing economic landscape. Diversifying into gold and silver can provide a hedge against potential currency devaluation, inflation, and other economic risks. By understanding these dynamics and taking proactive steps, individuals can navigate the challenges of the evolving global economy and ensure their financial security. If you want to stay most up-to-date on the silver and gold markets, make sure to subscribe to my daily 5-minute silver and gold newsletter. It provides the latest expert insights, breaking news, market trends, and investment strategies, all in a concise format. Click the first link in the description to join thousands of others and enhance your investment knowledge right now. If you enjoyed this video, please give it a thumbs up and subscribe to my channel. Your support helps me stay motivated to bring more valuable content to you. See you in the next video.